Welcome to The Marcus Warren Show, powered by 960 Digital and the Wealth Empowerment Network. Now, here is your host, Marcus Warren.
Good morning, good afternoon, good evening, and welcome to the #1 retirement and tax planning show in the region, The Marcus Warren Show. I am your host, financial advisor, tax enrolled agent, and author of the Retirement and Tax Playbooks, Marcus Warren. And I hope everyone is doing well on this Sunday. And to my left, I am joined by our resident tax professional, Dee. How you doing, Dee?
Hello, and happy Sunday.
And remember that if you miss any parts of the show and you want to catch up on anything you missed, all you have to do is subscribe to the Marcus Warren Show podcast via Apple Podcasts, Spotify, or wherever you get your podcast. Also, throughout the show, we will be offering our retirement rescue game plan. Now, you may be asking yourself, what is that retirement rescue game plan? And what it is, it's a physical, tangible packet of information that will help rescue your retirement from all the risk that threatens your nest egg. We're talking about market risk, inflation risk, and more importantly, tax rate risk. Now, in that game plan, you're going to get a copy of my 2 books, a few different financial reports, and access to my webinar entitled Taxes in Retirement. And you can simply order that by going to warrenwealth.net. You go to the site, you put in your information, and that retirement rescue game plan will be delivered free of charge to your front door. Once again, you go to warrenwealth.net. Anyway, let's get to Money Matters.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, 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 money,
Dollar, dollar, dollar.
All right, so I guess this segment we're going to cover really a critical issue that affects most Americans, and that is this ongoing debt ceiling crisis, right? This debt ceiling crisis that has at least some people talking. And so when you think about it, this issue that we're having, a crisis, it has some far-reaching implications for our economy and really the financial well-being of us Americans and families across the country. So let's do this. Let's dive into what's happening and what really this debt crisis means to all of us. So the debt ceiling is basically the legal limit on the amount of money the U.S. government can borrow to finance its operations and meet its financial obligations. So it's basically like a credit card limit. It's set by Congress. And once you get to the max of the credit card limit, if you want to surpass it or you want them to increase the limit, then government has to work out their issues in order to raise that debt limit. Now, if the government surpasses the limit, it can't borrow any more money until the debt ceiling is raised. Now, at the moment, we are facing a significant hurdle because the debt ceiling, it has been reached, and the government is basically operating on borrowed time. So the Treasury Department, in the meantime, they've been employing a lot of extraordinary measures to keep the government running without breaching that debt ceiling. However, these measures are only temporary and really can only buy us a limited amount of time. So what are these extraordinary measures that I'm speaking about? So, to manage the government's finances and prevent breaching that debt ceiling, there were a few different maneuvers and some creative accounting, that I call it, that is giving the government a quick pass for the time being. So one of the things they're doing is they are suspending, certain investments. So the Treasury, they can suspend certain investments in basically federal employee retirement funds, such as the Thrift Savings Plan, or a TSP. The TSP has a government securities investment fund, and they can just basically stop investing in that. And that basically frees up cash that would have been used to purchase government securities. Instead, they allow the Treasury to use those funds so they can pay and meet their other financial obligations. So that's one. A second thing they do basically is, I said some creative accounting, or they utilize what's called cash management, different cash management techniques. So what the Treasury does is they want to implement or employ various cash management techniques to ensure that the allocation of cash is strategic. So they'll prioritize payments to critical obligations like Social Security, Medicare, defense contracts, while they'll delay or they'll reduce payments to other government spending. So basically it's like, when I was fresh out of college, and I was broke. Bills would come in and I had decisions to make. You know what I'm saying? You get that check and then I have decisions. Check in my one hand, bills in the other. And in the middle is my mind making decisions like our U.S. government. Like, okay, I can pay this water bill, but let me hold off on the cable bill. Or, okay, I can pay the rent, but I'll just pay half of that car payment. You know what I mean? And, or it's like when you get that LG&E bill and you initially get it and you're like, you know what? I'm going to wait till the brown letter comes in. I'm going to wait on the brown letter. And those who know what I'm talking about, you know what I'm talking about. You wait on that brown letter from LG&E before you decide to make that payment. So basically what I was doing all along back when I was right fresh out of college and broke is I was doing what the government is doing, which is utilizing cash management techniques. That's good. All right, what else can they do? Well, they can temporarily suspend the issuance of debt. So what does that mean? That basically means that the Treasury can temporarily halt certain types of debt instruments, such as government, local bonds and Treasury securities. Basically, by doing this, the amount of debt that the government accumulates reduces, and they don't have to pay out those obligations by issuing more debt to themselves. And then last but not least, as far as what the federal government can do as far as these extraordinary measures, is they can utilize legal authorities to shuffle between accounts, right? Move money from one government agency to another to cover their bills.
Sounds legit.
Yeah, I mean, it's basically, it's like, hey, the government and finance and accounting is really the same for the federal government and even for households, right? You bring money in, and if you have more bills than you have money coming in, there's a debt, right?
Correct.
And how do you go about shuffling that debt and making ends meet? You basically utilize cash management techniques, or you do what they do here. You know what? They just move money between accounts. They rob Peter to pay Paul. So a lot of times, when you're thinking about budgets and finance and all that stuff, from individuals to small business to big business to the federal government, it's all the same. You have money coming in and you have money going out. And hopefully you want more money coming in than you have going out. And our current situation is that's not the case. And it's important to note that those measures that I talked about are really just short term. They're not sustainable solutions. So, the debt ceiling crisis, it can lead to a host of problems. First and foremost, it can trigger default on our financial obligations. That basically means that the government might not be able to pay all of its bills. So what are some of those bills? I'm going to tell you. Social Security, military salaries, interest on our national debt. So a default would have severe consequences for our credibility and basically could plunge our country into a recession or even a financial crisis. And of course, the impact of some sort of default, if it would get to that point, it would basically have ripple effects throughout the whole economy, right? So, like I said, Social Security recipients, veterans, federal employees, you may face delays or even you'll get temporary halts on receiving what? That money you need to pay your bills, right? So that ripple effect. And then if interest rates go up, right? If interest rates already been going up, but interest rates could spike, and that makes it more expensive for individuals and businesses to borrow money for mortgages, car loans, or investments. And if that happens, of course, we could fall into this recession that we've been waiting on for a while. So, it's crucial to recognize that the debt ceiling crisis is really just a matter of confidence. Let's talk about Wall Street. If investors and creditors lose faith in the U.S.'s government's ability to meet its obligations, then it could increase borrowing cost. It could not only impact the government, but it could trickle down to, of course, businesses and us individuals, making it harder for us to access credit. And then, of course, there's the political dynamics of all this. Raising the debt ceiling requires bipartisan support in Congress, which, of course, there's not a lot of bipartisanship going on right now. And unfortunately, in recent years, these discussions have become, contentious, just to say, a lot of gridlock, a lot of posturing and grandstanding. And many lawmakers, they argue that the debt ceiling does not equate raising the debt ceiling does not equate to the government getting a blank check to spend recklessly. And so they just bicker back and forth and back and forth. So, as, negotiations continue, we'll see what happens here in the next few days. If not, hopefully here soon, we'll see if they raise that debt ceiling, which I think they will, because they always bicker and bicker and bicker. And then they end up raising it. But, we're going to stay close to the situation and keep you all informed. All right, coming up next, we're going to discuss how this pending debt ceiling crisis, how it affects retirees and what you can do about it. You are listening to The Marcus Warren Show. All right. Here we go. Little uppity ditty. So this is Mr. Blue Sky.
Okay.
By the Electric Light Orchestra. Came out in 1977.
All right.
Number 35
Okay.
in the U.S.
Good.
Number 6
Hey.
in the U.K.
Okay.
There you go. So top 40 hit here.
There we go. Yeah.
There you go. Not bad.
I like it.
Me too. Mr. Blue Sky. Sounds like a little Beatles ripoff. Doesn't say the Beatles.
A little bit.
or maybe
Beatles-ish.
kind of ish. Some of the ditties, but then again, it also sounds a little like the Partridge Family. You know what that is. Anyway, welcome back to the show, The Marcus Warren Show. Remember, you can request that retirement rescue game plan. All you got to do is go to warrenwealth.net. That's warrenwealth.net. And you'll get a physical packet of information that includes two of my books, some financial reports, and access to my webinar entitled Taxes in Retirement. All you have to do is go to warrenwealth.net. All right. So I was talking about this debt ceiling crisis that is impending and looming, and you hear it in the news, and Congress and the red and the blues are going back and forth, and we'll see if we're going to get an increased credit limit on our credit card so we can continue to spend. But with all the bickering and babble that goes on back and forth, how does it affect retirees? Right, because this is a financial investment show focused on people who are near and in retirement. And so how does it affect you? So how does it affect you? So in addition to some of the, the broader impacts on the economy, it can have specific consequences for retirees. All right. And so, you've been working your whole life, you've getting your pension, getting your Social Security, you have your investments in your IRA, your 401k, and you're just kicking back and you hear about this crisis and you're like, it doesn't seem like it can affect me. It seems bad, but, it's just same old with our government. But oh no, contraire, mon frere. Let me tell you how it can affect you. Number one, let's talk about those Social Security payments. We all know that most retirees, they receive Social Security, right? But if the debt ceiling isn't resolved, there may be challenges in ensuring that those payments are going to go to you. Whether they're going to go to you on time or if they're going to be paid in full. And of course, what does that do? That creates more uncertainty and financial stress for those retirees who rely for Social Security as a significant portion of their income. By the way, which over 50% of Americans rely on Social Security as their major source of income. So that's significant.
Fun fact, $25 billion in Social Security benefits are due to be paid on June 2nd. Just June 2nd, not the entire month of June. The day after we're supposed to run out of money and not be able to pay our bills. $25 billion in Social Security benefits and $47 billion in Medicare is due on June 2nd.
There you go. And those are those healthcare costs, right? Healthcare, essential for retirees. And any disruption in that debt ceiling is going to impact your healthcare access, right? If the crisis leads to a government shutdown or funding cuts for Medicare, then of course that's going to create issues and challenges because you're going to have to pay potentially out of pocket if you have it until the government resolves those issues. And let's talk about some more guaranteed income. Let's talk about pension payments. We know that some retirees receive pensions, right? But if the debt ceiling isn't resolved and it leads to an economic downturn or any financial instability, then it could put pressure on companies and organizations that provide pensions. Number one, if your government pension is there, you may see some of that disrupted. If you have a pension with an outside company, with any kind of economic downturn and any kind of craziness that happens financially, it could cause some companies, they could reduce those pension benefits, or I'm gonna catastrophize a little bit, or some of these pension plans could fail, right? Which would obviously be detrimental to your long-term financial health. Not sure if that particular thing would happen, but I got to lay out everything that would be on the table. And then last but not least, we have we have Wall Street, right? And retirees have investments. Like I said, you have your money in your 401ks, your IRAs, your regular brokerage accounts. And if this debt ceiling crisis isn't resolved, then it creates instability. And what do the stock markets hate? They hate uncertainty and they hate instability, and it increases volatility. And this can have an impact on the value of your investments, your stocks, your mutual funds, your exchange traded funds, bonds. So if the stock market declines, or if interest rates continue to increase due to the debt ceiling, then you're going to experience a lot of that volatility in your portfolios. And if you have to pull out more because maybe your Social Security payments have stopped or have been disrupted or aren't 100% of its value, you may have to pull out more from your savings and retirement plans. And if there's instability, then you could be pulling out of a declining pot of money that you're used to having, right? And so when you see that, that could be financially devastating to your retirement and really your retirement future. So what can you do now to kind of mitigate some of those things that could potentially happen? And like I said, a lot of times there's a lot of bickering. It gets, you hear it on the news all the time and people get nervous. And most of the time they come up with a resolution. There was one time though when they did not. That was back when Obama was in office, and for a brief period of time, they didn't raise the debt ceiling, or for the first time in I want to say American history. Our credit rating, our credit score went from AAA and it went down, I guess, to AA or whatever that next level is. But then we raised the limit. And so, of course, they got it figured out. But that was the one time where they didn't raise it by that due date. And there were some disruptions for a little bit, but they got it resolved fairly quickly. So what can retirees do? Number one, you need to make sure you have a budget and a financial plan. Review your budget. Look at your expenses. Are you living within your means? Are you going to have to make adjustments? You want to know why? Because if your Social Security stops for a month or 2 weeks or whatever that may be, where you don't get it all, how is that going to affect your budget and your lifestyle? I would make sure that you diversify. We say that all the time. Diversify your investments because the stock market doesn't like uncertainty. And when there's uncertainty, there's volatility. And when there's volatility, if you have all your eggs in one basket, you can experience that volatility to the downside and be upset. So make sure that you are diversified. And then also just stay informed. I wouldn't recommend watching this 24-hour news cycle, or watching news 24 hours a day, because you will drive yourself crazy and just think the worst is going to happen. And of course, the worst could happen, but more so than not, just like I said, they end up resolving this before there's any real issues, because there are certain politicians that if we don't raise the debt ceiling, that's going to be held against them when they are up for re-election. So a lot of them want to get a deal done. Speaking of that, you can advocate, right? Call your representatives. Do all that stuff that they always tell us to do. Voice our opinion, voice our concern. Make sure we call our congressmen or our senators. You can do that. But I just know that a lot of people don't think that the debt ceiling will affect them until it's too late. And then they realize, oh, wait a minute, I'm not getting my Social Security payment this month. Wait a minute, Medicare, that's been halted for a month or so. And then that can be a big slap in the face. So make sure that you are up and staying aware and planning for the worst, but hoping for the best. You're listening to The Marcus Warren Show.